As the crisis in the market deepens, we are starting to see more and more CEOs publicly state the obvious truth. The United States is likely heading into a deep recession. Jamie Dimon, the CEO of the largest bank in America, JP Morgan Chase, made headlines earlier this week after he was quoted openly saying that the country will likely dip into a recession 6 to 9 months from now. But it wasn't those words that turned heads. His follow-up explanation set off a few alarms across the finance landscape. Take a listen to this clip from the interview.
So I think you got to put two things in mind here. Currently, right now, the U.S. economy is actually still doing well. Consumers have money, fiscal stimulus, they still have more than they had before. They're spending 10% more than last year, 35% more than pre-COVID. Their balance sheets are in great shape. Yes, debt's gone up a little bit, but not nearly to pre-COVID levels. And therefore, even if we go into recession, they're going to be in much better shape than 08 and 09. Companies are in good shape. Credit's very good. Markets are still open, though rocky and stuff like that. But you can't talk about the economy without talking about the stuff in the future. And this is serious stuff, okay? This is inflation, which obviously is changing the effect of those numbers I just told you about. It's rates going up more than people expected already, and probably a little bit more from here. It's QT, which we've never had before. So therefore the unknown effects, and you see it today in bond markets around the world and sovereign markets and people selling U.S. Treasury debt, and it's the war. And these are very, very serious things, which I think are likely to push the U.S. And the world. I mean, Europe is already in a recession, and they're likely to put U.S. in some kind of recession 6 to 9 months from now.
So one thing to note from this interview is that Mr. Dimon mentions how QT, or quantitative tightening, has never happened before, and this is a really important fact when we look at markets going forward. Now, without getting too technical, we need to understand how QT works in order to understand the extreme danger of this untested policy. Basically, in order to stimulate the economy following the disaster that unfolded in 2008, the Federal Reserve began to do something called quantitative easing, or QT. This is when a central bank, or in our case the Fed, purchases large quantities of government bonds and other securities on the open market in order to hold down long-term interest rates and signal loose monetary policy. Think of it as injecting steroids into the economy. Now, when they do this, the stock market gets pushed up, interest rates come down, and making money as a business becomes easier. The scale of this policy can be tracked by looking at the Fed's balance sheet, which is essentially a showcase of what it owns. Long story short, this controversial policy is criticized by many who claim that it's overused. Remember, the central bank quite literally has unlimited money, so purchasing things in the open market can be done by just printing more dollars. Now, with that said, the consequences of printing too much money can be very harsh, and plenty of empires and countries have learned that the hard way. But in summary, that's QE, and we've actually never had a duration in the past 15 years where the Fed balance sheet was reduced other than a brief period in late 2019, when the Fed does the opposite and sells those assets on the open market, reducing its balance sheet. It's called QT, or quantitative tightening. This is done mostly to fight inflation, and there's a theory out there that any type of QT will result in a financial disaster. Remember, we've never tried QT before. It's been nothing but economic steroids for the past 15 years, and now many claim that QT is going to break something. A quick history lesson supports this notion. If you remember, prior to 2020, before anyone even mentioned the word COVID, the Fed was already stepping into the markets to fix what was then a tiny QT experiment. From about March 2018 to summer 2019, the Fed reduced its balance sheet by just a tiny bit and rose the interest rate a mere 3%. And with it, the economy was already starting to break. The Fed was then forced to quickly reverse course and introduce QE once again, and then the pandemic happened and QE was kicked into overdrive. Now, with real inflation concerns, the Fed has been trying this experiment once again, but this time with much more punching power. And with this untested strategy, things will undoubtedly begin to break. Jamie Dimon thinks that the market could easily dip another 20% from here. Take a listen to him explain his thoughts in detail. But before I show you the clip, take a second to hit that like and subscribe button if you're enjoying the content. Now back to the clip.
If we do see the U.S. go into recession, how severe do you expect it to be, and how long do you expect it could last?
Yeah, well, this is the thing no one ever really knows, right? You do have a strong consumer going into it. Businesses are in pretty good shape, but they were amazingly resilient during COVID. Even the ones that had no government support and stuff like that. And I think governments did do a hell of a job getting the thing to recover. So we don't know. I mean, now you have to look at the range of outcomes. It can go from very mild to quite hard, and a lot will rely on what happens to this war. Mm-hmm. So I think to guess is hard. Be prepared. But the one guarantee, which we've been consistent about, is volatile markets. You're going to have volatile markets. You've already seen Market's down quite a bit, no IPOs, very little high yield, bridge loans being hung and stuff like that, which is pretty typical, but it's still been orderly. I think it's possible you can see it be disorderly sometime in not too near future.
Now with that said, Dimon makes another overlooked point in that last clip. The destruction so far has been orderly. Yes, the S&P 500 has dipped over 20% in the last 10 months, but it's been mostly a slow grind down with seemingly very little panic selling. We can see this with the VIX. It's a very important index used to track volatility. The highest this ever traded was at 89 during the worst days of 2008. As an example, during the initial COVID panic, the VIX rose to 66. Now, over the last 2 years, it's been mostly flat with a few interruptions, but never a super spike like we saw in 08 or 2020. Most market participants are on edge waiting for that one event that will send this index into the stratosphere, and it's only at that point where markets will truly begin to break. Extreme volatility wreaks havoc on all kinds of derivatives and sucks up liquidity, causing massive stress on the entire financial system. So far this year, the markets have been terrible, but they haven't had that meltdown moment, and this is what Dimon is referencing. Many fear that the war in Ukraine could be the source for this meltdown point, and with escalations rising, it's no wonder why we're seeing the VIX creep back up. To be fair, Dimon ends the interview with a relatively positive note, saying that while the Fed is playing catch up with the markets trying to tame inflation, it's still very possible we have a soft landing. Now, of course, being the CEO of America's largest bank, you have to throw in some positive nuggets following those earlier doom comments, but in either case, the war in Ukraine is the single biggest threat to the markets going into 2023. Take a listen to Dimon explain.
How do you think the Fed is doing in managing this whole situation?
Well, let me give them credit for what they did in COVID. And I hate to second guess people because I think it's easy for everyone to do. In hindsight, they waited too long and did too little, and QT should have started soon and all that. But they're clearly catching up. They're clearly motivated to catch up. And from here, let's all wish them success and keep our fingers crossed that they manage to slow down the economy enough that it doesn't, to cause whatever it is mild. And it's possible. I wouldn't take that off. I think that, like I said, the far more serious thing is this war. Far more serious than the short-term effect of the economy and things like that.
Whatever you may think, it's extremely concerning hearing the CEO of Chase openly say that we're heading into a recession and that more bad is to come, given the fact that we're already down around 25% on the year and the fact that rates continue to rise, with a 30-year mortgage now creeping up on 8% on top of sky-high prices. The reality is quickly getting ugly. Let me know what you think in the comments below, and don't forget to hit that like and subscribe button if you enjoyed the video.